Halloween morning, 2011. 4 in the morning. Lawyers sit in a conference room this close to a deal that would save the company. Then an auditor calls in with 3 words that kill it. The money is gone. $1.6 billion, belonging to farmers, traders, small investors. The man responsible was a former Goldman Sachs CEO and the governor of New Jersey. He told Congress, completely calm, "I simply do not know where the money is." He paid a fine. He never went to prison. This is that story. To understand how this happened, you have to understand who Jon Corzine was before the disaster. He did not come from money. He grew up in a small farming town in Illinois, the kind of place where people use commodity brokers to protect their harvests. He worked his way up Goldman Sachs for decades, taking every hard assignment until he reached the very top, co-chairman and chief executive officer of the most powerful investment bank in the world. At Goldman, he made $400 million personally. He was in rooms with central bank governors. He took calls from finance ministers. He did not just understand global finance. He shaped it. Then came politics. In 1999, after losing a power struggle at Goldman, Corzine spent $63 million of his own money to win a Senate seat in New Jersey. Then he became the state governor. By any measure, he was the most credentialed financial figure in American public life. So when he showed up at MF Global in 2010 and said he was turning this quiet brokerage into the next Goldman Sachs, people believed him. Why would they not? He was the man who had actually built Goldman Sachs. MF Global was a middleman, the bridge between a corn farmer in Iowa who wants to lock in a price for his harvest and the trading desks that make those deals happen. Steady, unglamorous, safe. Corzine did not want safe. He began buying European government bonds. Italy, Spain, Ireland, Portugal, Belgium, $6.3 billion worth, at a time when every major institution on earth was running away from those exact bonds because Europe was in a full-blown debt crisis. But Corzine had a theory. He had sat in rooms with European central bank officials. He believed they would never allow a sovereign default. He was right, and the market was wrong. And because he was Jon Corzine, nobody at MF Global had the standing to tell him otherwise. $6.3 billion in risky European bonds would normally trigger every alarm at a firm this size. MF Global's entire equity cushion was a fraction of that number. This bet could wipe out the company several times over. So how did Corzine keep it out of sight? Not with fake documents, not with offshore accounts. He used something completely legal, a structure called a Repo-to-Maturity transaction. Here is how it works. You buy a bond, then you sell it to a bank with a promise to buy it back later, right when the bond matures. The cash comes in today. The bond technically leaves your balance sheet, but you still own every bit of the risk. If that bond crashes before maturity, the loss is entirely yours. You have just made it invisible in the meantime. MF Global applied this to $6.3 billion of European debt. Anyone reading the basic financial statements would never see it. You had to dig into the footnotes to find the exposure. Almost nobody did. The firm's own risk managers did, though. They raised the alarm multiple times. The positions were too large. The leverage was extreme. The downside scenario was existential. Corzine overruled them every time. Not because he had better data, because he had more confidence. This is what hubris looks like in practice, not a cartoon villain. A brilliant man who has been right so many times he has stopped imagining being wrong. And while the hidden bet grew, the core business was quietly dying. Traditional brokerage revenues fell every quarter. The European trade was not just a bold strategy. It was the only thing keeping the numbers from looking catastrophic. The whole machine ran entirely on one man's conviction. The Securities and Exchange Commission noticed something wrong early in 2011. Months before the collapse, regulators were already in an open dispute with MF Global about how those positions should be classified on the balance sheet. That dispute was not a secret. It was disclosed in public filings, a flashing red light visible to anyone paying attention. The credit rating agencies were watching too. The firm had been on a watch list for a downgrade for months, linked directly to its European exposure. And that exposure was right there in the annual report footnotes. $6.3 billion in Italian and Spanish government bonds at a time when those countries were dominating every financial headline on Earth. The warning signs were never secret. They were just boring. Nobody clicks on a story about footnote disclosures. The financial media was covering the European debt crisis at the macro level. Almost no one connected it to a mid-size American brokerage sitting on more European sovereign debt than most hedge funds. Almost no one. Until October of 2011, when the Securities and Exchange Commission forced MF Global to bring those positions fully onto the balance sheet, visible to the entire market, all at once. October 25th, MF Global reports a quarterly loss of $192 million. The full European exposure is now visible. Rating agencies move immediately. Junk status, margin calls flood in. The firm needs cash fast and is running out of places to find it. What happened next separates this story from every other Wall Street blow-up. As the crisis accelerated, money began moving from customer-segregated accounts. These are accounts that commodity law treats as completely untouchable. They belong to clients. A brokerage cannot legally use them to cover its own trading losses. Period. The money moved anyway. An internal memo obtained by congressional investigators described one critical transfer as made per JC's direct instruction. Halloween morning, 2:30 in the morning. Auditors doing a final check for a rescue deal discover a hole in the customer accounts. The deal collapses instantly. MF Global files for bankruptcy before sunrise. $1.6 billion in customer funds is missing. Thousands of farmers and traders are locked out of their accounts for years. In 2017, a federal court ordered Corzine to pay $5 million in civil penalties. No criminal charges were ever filed. $5 million for losing $1.6 billion of other people's money. So what do you take from this? First, credentials are not risk management. Corzine's Goldman Sachs reputation caused everyone around him, investors, board members, regulators, to defer to his judgment instead of questioning it. When you evaluate any investment or leader, ask yourself, would I approve this if it came from someone without the famous name? Separate the idea from the person pitching it. Second, the danger is always in the footnotes. The entire MF Global bet was disclosed in public filings. Nobody read them carefully enough. Before putting money into any financial firm, look at the derivatives section, the off-balance sheet items, and any unusual concentration of credit risk. Complex language buried in footnotes is rarely a coincidence. Third, understand what your money is protected actually means in practice. MF Global's clients had legally segregated accounts. The protection was real, and it still took years to recover their funds. Knowing the rule exists is not enough. Ask exactly what happens to your assets the morning a firm files for bankruptcy. Ask before you invest, not after. Fourth, watch for any leader who bets the entire firm on a single conviction. Corzine placed a wager larger than the company's total equity on one macro view, then used a legal structure to hide it. When a leader's strategy requires leverage that dwarfs every industry peer, you are not investing in a business. You are financing one person's belief that they are smarter than the market. The next fraud is already being built. The footnotes are already written. Subscribe so you catch it before the collapse. And if this case made you think twice about who is actually watching your money, drop a like. Next up, watch what happened when an entire institution decided one man's instincts were worth more than 200 years of rules.